Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the fourth quarter of 2022, and that stock is Raytheon Technologies. And this stock is basically an aerospace and defense company that builds advanced weapon systems for commercial, military, and government customers worldwide. They also specialize in cybersecurity and electric propulsion, so they're competitive to companies like Boeing and Lockheed Martin. And so basically in this video, I'm going to talk about some of the recent news that came out surrounding Raytheon, and then also figure out the intrinsic value per share so we can know if this is a good price to buy into the stock from a value investing perspective. And so right here in this article, they talk about how in 2022, Raytheon did pretty good business and that they expect to see some more of the same in 2023. If we scroll down here, we can see that their revenue for the fourth quarter grew 6% year over year, so definitely pretty good revenue growth for Raytheon there. And then for 2022 as a whole, it grew around 4% year over year from 2021 to 2022. Also, if we scroll down here, we can see that they point out that roughly 92% of Raytheon's improvement in profits last year came from just two divisions, which were the aerospace division and the commercial travel division, which is obviously booming now because of the post-pandemic shift away from lockdowns to people traveling using airplanes again. So that's definitely helping Raytheon's business. And then lastly, if we scroll down here, they point out that right now Raytheon is one of the key suppliers of defense of Ukraine. And so the war in Europe right now is actually contributing to Raytheon's business growth, and they hope to continue to see more of that, or not really hope, but they expect to see more of that in 2023. And then also we can see right here that they've also landed a dozen defense contracts in 2022, including $210 million for airplanes, $415 million for missiles, and $1 billion for classified contracts. So definitely a lot of interesting business coming up for Raytheon in terms of signing contracts with the government. And then also for 2022, they didn't do half bad. They improved their revenues and they improved their earnings, which you'll see right here in their income statement. So we can see they're comparing 2022 to 2021 and 2020. We see total sales were up from 64 billion to 67 billion in 2022, and then net income was up from around 3.8 billion to 5.2 billion dollars. So that is some pretty impressive growth for Raytheon Technologies year over year. Then right here we can see their balance sheet for 2021 and 2022. Total assets are down to 158 billion from 161 billion. And then we can see that their total equity is down to 74 billion, or 74.1 from 74.6 billion. But even though their total equity is down, their retained earnings line item is up. So the main primary driver for this decrease in equity is the increasing treasury stock account, which basically increases when a company repurchases shares of common stock. So they're returning value back to shareholders, and they also had positive earnings, which is giving them more money to distribute to shareholders. And lastly, right here, we can see their cash flow statement comparing 2020 to 2021 and 2022. In 2022, operating cash flow was $7.1 billion, and then they returned around almost all of their operating cash flow back to shareholders through dividends of $3.1 billion and share repurchases of $2.8 billion. So that's around $6 billion of their $7.1 billion returned to shareholders in 2022. So that's probably one of the reasons why their stock has outperformed the rest of the market over the last year here. So definitely a pretty good sign for shareholders of Raytheon over the last year. So right here we can see this is a discounted cash flow model to figure out the intrinsic value per share for Raytheon. They're estimated to grow at around 13.4% for the next 5 years. They had around almost $5 billion of free cash flow in their most recent year, around $27 billion of debt on their balance sheet, and 1.4 billion shares outstanding, which puts their intrinsic value per share at $41 per share, which means at the moment they're currently not trading below intrinsic value per share. They're trading at $99 per share, almost $100 per share here. So they're trading at basically more than double their intrinsic value per share at the moment, based on these estimated growth rates for the next decade. And then right here I did a competitor analysis comparing them to two of their main competitors, Boeing and Lockheed Martin. In comparison, we can see that they had the highest gross profit margin but they are losing to Lockheed Martin on all of the other areas of this competitor analysis. Boeing is not profitable right now, so they don't really show up anywhere on this list, including dividends per share, because they don't pay a dividend. But we can see that Lockheed Martin pays a way higher dividend of $11 compared to Raytheon's $2. They're trading at a better price to earnings ratio of 21 times earnings compared to Raytheon's 28 times earnings. They have 11% return on assets compared to 3% for Raytheon and 8% net income compared to 7% net profit margin for Raytheon. So gross profit margin, Raytheon is beating out Lockheed Martin, but pretty much all across the board, Lockheed Martin is beating out the rest of the competition here across all of these other areas. So from a competitor analytical standpoint, it would look like Lockheed Martin would probably be the buy here, not Raytheon Technologies. And lastly, I want to compare them to some of the companies we've looked at in prior videos. We can see that in terms of share price compared to intrinsic value, Raytheon Technologies is currently trading at around 2.43 times their intrinsic value per share, because it's around $41 and they're currently trading at basically $100 per share. The only stock on the list so far to be trading below intrinsic value per share is Albertsons at 0.45 times their intrinsic value per share. Then we can see in terms of growth rate that Raytheon comes in third place right now, right behind Netflix and Adobe at 13.4% projected growth rate for the next 5 years. In terms of gross profitability, Raytheon comes in dead last at 20%, with Adobe still holding the number one spot at 89%. In terms of net profit margin, we can see Raytheon has 7% ahead of Albertsons, but not beating out Microsoft's 36%. And then in terms of stock performance, we can see Raytheon is in 7th place, only ahead of Johnson & Johnson, with their 31% performance for their stock price over the last 5 years, whereas Microsoft basically returned around almost 200% to their shareholders over the last 5 years in terms of stock performance. And so obviously, these companies are competing in different industries, so they're going to have different ratios. But in terms of comparing them from a video to video standpoint, it looks like Raytheon is not doing as good as some of the other companies we've covered in terms of financial ratios, stock performance, and intrinsic value per share. In terms of competitor analysis, it looks like Lockheed Martin is beating out the rest of the competition here. And then in terms of this intrinsic value analysis, it looks like Raytheon is currently not really trading at a good buy right now. With that being said, considering the fact that they are one of the main suppliers for defense of Ukraine at the moment, it'll be interesting to see how this stock grows in 2023. So let me know in the comment section down below what you guys think of Raytheon. If it's a buy or a sell right now, let me know. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.